If the constant noise around money being in the headlines is doing your head in, then today we're going to talk about what it means for your personal economy. Welcome to the Evalesco Healthy, Wealthy and Happy podcast. My name is Jeff and I'm joined once again by Marshall. Welcome back, Marsh.
Thanks, Jeff. Great to be here.
So today we're not going to be talking about predicting markets or reacting to headlines. It's really about making you feel calmer, more in control and focused on what actually matters. And that to us is your personal economy. So Marsh, we've seen how, I guess, over many years, things can change really quickly, particularly in recent times. Things like tensions flaring in the Middle East, which leads to oil price jumps. And then just as quickly, governments intervene and prices, unwind. When people see that kind of volatility, what's the first thing you want them to remember?
But the first thing I'd like them to remember is that speed or volatility doesn't equal permanence. So markets do react to new information like humans at all. They also react to fear. And it's really important that we don't take in a headline or see what's happening in the marketplace and believe that we actually have to do anything. That's information that's out there in the ether, and certainly sensible investment managers will make decisions based on that, but you as the ultimate investor don't need to react to that information.
Yeah. So I think headlines sell newspapers, they sell ads on the TV, and we can see why they're there. And sometimes can be interesting information.
It can be.
Yeah. But we often talk about, look past the headlines and focus on your personal economy. So what do you actually mean by that?
Yeah, so what we mean by that is, over many years, we've identified that, at an individual investor level, it provides reassurance, certainty, and long-term outcomes if you can focus on the things that you can control. So that doesn't necessarily mean what's happening to the price of oil, which has changed dramatically in the last 48 hours. It means focusing on what you can control. So ensuring that you're spending less than you earn, you're allocating capital to reserves, you're paying off your mortgage, you're living within your means and you're investing sensibly. And for those that are in the workforce, the other thing to really focus on is growing your capacity to earn an income.
Yeah, I think where it can be practically impactful is if there are big long-term swings in the cost of things. So like a short-term, hit at the petrol bowser is annoying when you're going on that road trip on the weekend and you're paying more for it. But thinking about, is that having a long-term impact to your ability to spend less than you earn? If it does, then by all means, you should sit down and take some action and we can help and talk through that. But typically that's not the case.
No, that's true.
So when oil or rates, interest rates do move around, how should people think about what really flows through versus what's just noise?
So typically it does take quite some time for a headline or I guess a movement in a particular market to flow through to your bottom line. So cash rates can sometimes be a little bit more immediate because no doubt you've noted the times when the RBA has changed cash rates. Typically when rates go up, they get passed on almost immediately.
Yeah.
When reductions occur, it might take the banks several months to pass those through. So cash rate movements do flow through straight away, both in terms of what you're earning on your cash and savings accounts, what it's costing you in terms of your mortgage, what you're paying each and every month. So that certainly flows through straight away. Other factors such as movements in the Australian dollar, oil prices do sometimes take a little bit longer to flow through. Now, when they do flow through to, as you said, the bowser, if that is for a sustained period of time, you might get other flow-on impacts. So, for example, the longer the fuel rates stay high, the more likelihood that inflation, for example, might start to pop up, because if the cost of transport, the cost of producing, moving food and groceries, for example, to Woolworths or Coles, increases, then that's going to be passed on to you as the end consumer, which ultimately means that you're going to need to start putting aside a little bit more for the week-to-week grocery bill.
Yeah, I think that's a really topical point at the moment, isn't it? When you think about inflation being consistently higher than the RBA's preferred band, we can see the cost of living is becoming real. And so that flow on effect of an increase at petrol, I guess, is not just about the road trip on the weekend. It's, down the track what that means for overall inflation, and then what that means for interest rates. So the RBA under pressure, I guess a few weeks ago, the predictions of another rate rise anytime soon were pretty low. They think they rose recently, but now people are saying, well, maybe they'll need to increase rates because inflation is going to kick up again.
Yeah, so I mean, if you sort of go back 12 months, a lot of investors certainly got excited, and also those that have a mortgage were pretty excited about the fact that rates were starting to come down. But it's certainly presenting now as though there's at least one or two more rate increases happening or expected before the end of the year, which is to a degree a little bit counter to what we're seeing in, with overseas central banks. So clearly inflation is ahead of where the RBA wants it. They're going to have to start ratcheting up rates a little, which isn't going to be great for those with a mortgage. On the flip side, retirees would be probably a little bit happy with the fact that they're going to get a little bit more earnings on the cash savings that they've got.
Yeah, exactly right. So when a headline hits, you see it on the news at night time or the market report, what's a simple filter or process that people can think about before worrying about acting on that?
Yeah, there's a few things that you can process. So what I'm hoping is that investors and clients that have worked with us for a number of years, if, when confronted with a headline, it's really important that, at least several times a year, there is a headline that screams some sort of a cataclysmic event, that the world is going to end and this time it's different.
Mm-hmm.
And for those investors that have been with us 5, 10, 15, 20 years, they've been through many of those experiences. And, the positive thing is that on average, portfolios are well and truly ahead of where they were many, many years ago.
Mm-hmm.
And that's after going through all of those pretty confronting experiences. The other thing to sort of fall back on is it noise? Is it something that's encouraging me to make a decision? And if so, do I actually need to act on that? So the first thing in that space would be to, go back to basics, consider your plan and the conversations that you've had with your advisor, and consider, well, do I have backups in place that are going to ensure that I can trade through this? It's a considered choice where we typically have 18 to 24, sometimes even 36 months worth of personal spending sitting in cash for our retirees for this very reason.
Mm-hmm. So it's about, I guess, not being responsive or reactive. It's about having a considered approach to it. Usually the right thing to do is to sleep on it and then ask some questions and, think about how do you stay in control. So if we think about being in control, what are some of the good signs of having a plan which is in control right now?
I guess the good signs are, if I were to reflect on the clients that we've worked with over the years, it's actually the dramatic reduction in inbound phone calls that we get when markets move adversely. Mm-hmm. And that's because the investors and clients that we work with are more confident and reassured through the way in which we build portfolios and the structures that we have in place. So if I were to go back 10, 15 years, it's quite likely when the Australian share market moved by the quantum it did yesterday, either side of 4%, which is a substantial swing, I would have expected to get a few phone calls. And my understanding in speaking with the team is they didn't get a lot of inbound traffic. They might have had one or two emails, but not a lot. And that's because clients feel confident with the plan that is put in place. They understand, the way in which we put together portfolios, and that, there are ways in which we can manage that process more effectively than jumping to or responding to a particular headline.
Yeah, absolutely. One of you kind of touched on it there. A question that you sometimes see people ask is, if markets are tanking or I'm feeling concerned, should we just go to cash until things settle down? We've had those questions in the past, as you said, not a lot recently. How would you respond to somebody who kind of drew that at you?
Yeah, so the challenge in going to cash is you're making that decision typically when, you're being confronted with headlines. Often there's an absence of information, so you're reacting to and what is a fairly volatile and emotional experience. And if I were to think about the last 24 hours, if you'd have said, look, I'm going to go to cash, overnight, market stabilized, the G7 came in and effectively released some of their strategic oil reserves and markets rallied. So you're making a decision with, I guess, a small amount of information. And by implementing that or actually going to cash, the hardest thing is, when do I go back in? Because what happens with markets is, and it's really important to consider, that they are forward looking. So markets respond to negative information or uncertainty. And when, in this instance, you could see that they responded very dramatically with a sharp drop in share markets. But as soon as information came out that was reassuring, indicated that supply was going to be maintained, they rallied really quickly. And individual investors, really, we don't have the ability to go in and out seamlessly and ensure that we miss that rally, which can be a very powerful ingredient in long-term investor returns.
Yep, absolutely. So just briefly, we have advisors who are helping people to focus on their own personal economy. We also have professional investment managers that we work with, the likes of Aspen, who manage some of our SMA portfolios. What sort of role does Aspen and all professional investment managers have in helping people to work through volatile times in markets?
Yeah, the important thing to consider is that Aspen's role and the investment manager's role is to ensure that there's multiple sets of eyeballs on each component within the portfolio. So that improves governance, it improves decision making and accountability, and ensures that, I guess, as a group, we're able to move beyond building a specific standalone portfolio for one investor, but we're able to invest as a collective, which in our experience improves outcomes for investors, improves decision making, and ensures that we're effectively allocating capital to those we would consider to be the best at what they do.
So I think one of the things you've spoken about previously was, keeps clients focused on outcomes and not looking at the headlines, which is hard to do. In closing, Marshy, if there was one thing from today that people should remember, what would it be?
I'd say that, when you're a couple of things. So when you're confronted with a headline, you're probably best off turning off the news and not focusing on it, but really ensuring that you're investing in that relationship with your advisor. And if you see something that you do have a question, it doesn't hurt to ask that question and go back to your advisor and allow them the opportunity to reinforce the underlying principles that focus on or created your plan, and to ensure that you do have confidence that you're able to trade or, I guess, invest through this period.
I think you're right. I think the headlines aren't going away. Sometimes it's interesting. Sometimes it's even entertaining, watching some of those things. Oftentimes it is just a little bit frustrating and confusing. So the key is really, the next step isn't necessarily action. It's about seeking clarity, getting clear on what you should be doing for your own personal economy, and taking action in that regard.
I mean, I'll come in with one last sort of line, and that's that over the years, as you touched on, that it can sometimes be a little bit amusing, because headlines are there to encourage you to click on a link, read the article, subscribe to a particular news source, take action. They're not there to create investor outcomes. And sometimes the headlines are fed by those that want you to do the wrong thing. When you have a relationship with an advisor, they're there to ensure that you do the right thing and deliver outcomes for you and your family.
Fantastic. Great place to finish. Thanks, Marsh, and thanks for listening at home. Have a healthy, wealthy, and happy day.